In the first user guide video, What to Expect, I mentioned that I refrain from involving myself in your personal risk management. I can nevertheless offer my take on the issue of slippage and the placement of stop-loss orders. Slippage is a term that refers to the process by which the market may penetrate key price support or resistance levels on an intra-session basis. So, if you're using a daily chart to determine your buy and sell signals, it's considered intra-day slippage. If using a weekly chart, then intra-week slippage, etc. As illustrated in the fourth user guide video, defining buy and sell signals, if the market in question not only slips through a key resistance area, but ultimately closes the day or week above it, then it's prompted an actionable buy signal. But as you're probably well aware, just as often the market in question can penetrate a key resistance level, perhaps briefly or for the better part of a day, only to break back and close the session below it, in the process denying an actionable signal. As you might imagine, this slippage business gets into a gray area. For one trader's slippage is another's actionable signal. I offer no hard and fast rules here, but in my own mid to longer term trading and investing, I generally employ a 1% price support violation threshold for establishing my stop loss parameters. I also use the same 1% threshold as the margin by which any market must settle beyond a key technical price level in order to establish a valid mid to longer term signal to act on. If you're a little confused, rest assured I'll be exploring both rules in the minutes ahead. To illustrate my point on stop losses, let me give you an example not long ago where I put the 1% rule to good use. In my weekly SPY report for the week of Monday, October 6, 2014, you can see I called a sell signal following the previous week's settlement below the 194.21 formation, anticipating a test over the following 3 to 5 weeks of the longer-term 182.42 channel bottom. As it turned out, the market took only a full week of activity to reach the 182.42 target. This downside acceleration fueled in part by fear of an economy paralyzing West African Ebola virus. I placed a resting buy order at 182.45, just above 182.42 support, and my good to canceled stop loss at 180.60. In other words, at a 1% downside violation of 182.42. Before I continue with the details of this particular trade, I think this is a good moment to briefly illustrate how a 1% technical price support stop loss can either complement or conflict with your own risk management rules. Let's assume for the sake of simple math you have a $100,000 trading account you've set up exclusively for SPY trading. That's the S&P 500 SPDR ETF. And that your usual buy order is 1,000 shares. Let's also assume that your personal risk management rule stipulates that you'll not risk more than 2% of your total account equity on any given trade. So if you purchase 1,000 shares at 182.45 and then stop out at 180.60, you'd have given up $1,850, which with a $100,000 account would in fact comply with your 2% drawdown rule. However, if your risk management rule is a bit more conservative and you limit your drawdown per trade to, let's say, 1% of your total account equity, you would need to reduce the number of shares purchased from 1,000 down to 500, which, if stopped out at 180.60, would result in a $925 loss, inside the 1% drawdown threshold for a $100,000 account. Returning to the SPDR ETF trade, as it turned out, the market slipped ever so briefly below the 182.42 channel bottom by roughly 0.3%, placing a move low at 181.92 before sustaining one of the more impressive rebound rallies of the decade. Another good example of the 1% technical price support violation rule for determining longer-term signals occurred recently in the West Texas Intermediate crude oil market, otherwise known as New York crude. Except this time, it was a little messier. Following the weekly settlement below this 71.43 formation in late November 2014, I called a 2 to 3 month 45.35 price target, a simple trend line extending more than 15 years off the 1998, 2001, and 2008 lows. On the first test in mid-January 2015, the market slipped through the 45.35 price support by roughly 2.5%, exceeding the 1% price violation. 2 weeks later, it slipped through by roughly 4%. While it certainly violated this long-term trend line on an intra-week basis by anywhere from 2.5% to 4%, as of this late February 2015 recording, New York crude has yet to elicit a secondary long-term sell signal by closing the week below this important trend line. At the same time, my next meaningful longer-term sell signal in crude oil would once again incorporate the 1% price support violation for establishing sell signal legitimacy. In other words, this trend line is at 45.61 for the week of Monday, February 23rd. A 1% violation of 45.61 is 45.15. Therefore, not until the April 2015 New York crude oil contract settles the current week below 45.15 will we consider acting on a meaningful longer-term sell signal, then expecting a test within several months of the 2008 32.40 low. A settlement inside the 45.15 to 45.61 region would be considered too close to call, while continued weekly settlements above the 45.61 trend line should yield upward price recovery into summer trade. Keep in mind these 1% technical price support violations are well suited for mid to longer term market signals, and know that I do a good job of mentioning them in the newsletter commentary. But ultimately, these are relatively arbitrary thresholds intended to instill a certain degree of risk management clarity into the overall equation. Once again, there is no correct way to either analyze the market or to manage your risk. Many of my subscribers are institutional traders and risk managers experienced in the subtle nuances of effective trading, who typically use my advisory service with an already well-defined risk management approach. While effective market analysis like mine certainly plays an important role in effective trading and investing, if you're a newer trader or investor, never lose sight of the fact that a core component to successful market navigation is a rigorous devotion to sound management. Thanks for viewing the user guide videos. I hope you found them helpful. If you have any questions related to making good use of my analysis, please don't hesitate to call our office or shoot me an email. I wish you the very best in successful trading and investing.